Hello and good morning, everybody. Welcome to our next webinar on the secrets of a successful retirement. Today's presentation is all about how to pay less tax. And I know we all enjoy learning a little bit about that every way we can. My name is Tara Kendrick. I'm here with my business partner, Bill Witt, and we're part of Senior Resource Center in Austin, Texas. As a Senior Resource Center in our company, we help in 4 specific areas. The first one is comprehensive retirement planning, helping people look out 30 years and making sure that they don't outlive their money. The second one, which is one we're focusing on today, which is tax planning and ways to pay less tax. Long-term care planning is our third way. We help with federal and state programs, including Medicaid and VA planning, along with other insurance products, and then estate planning. Just teaching people layman's terms about how to care for their estate while they're alive and after they pass. So, further ado, I'll introduce my business partner, Bill, and let him take over.
Thank you, Tara. And let me add my welcome to Tara's. We appreciate everybody joining us. Many of you have been with us over this. It's going to be a 13-week odyssey of covering different topics. And, it kind of tells you the complexity of retirement planning. It's not quite as simple as maybe Ozzie and Harriet driving off into the sunset. So I always start my webinars with a disclaimer, and this one is just to tell you that Tara and I are not CPAs. We do tax planning, not tax preparation. So we always tell people refer all tax preparation questions to keep our friends at the IRS happy to a tax preparation professional. Also, everyone's situation is unique. We're going to go over a case study today and show you the result for one family, but everybody's results are different, and historical performance is no guarantee of future performance. So what's the problem? And I think there was a quote attributed to Mark Twain, but it actually goes back. Ben Franklin is actually the original author, and it had to do with death and taxes, that they were inevitable. And I think a lot of us have that as a point of perspective that, well, the government passes taxes and we just have to pay our fair share. And what Tara and I have found over the years in working with folks on retirement planning is that we often have choices that can reduce or delay or eliminate taxes. And with smart planning, we have the ability to do that. And the problem is the United States has one of the most complicated tax systems in the world. The tax rules are complex, they're constantly changing. And if you don't have a plan to pay less tax, it can impact your safe, secure retirement. And just to kind of give you a perspective, when I prepared this presentation, I thought, well, there's income tax and I guess there's sales tax. But you start making a list of all the myriad ways that we are hit with taxes, and it's kind of overwhelming. We know about income tax, obviously. There's a tax that's taken out to pay for Social Security. There's the Medicare tax that helps fund it. Then there's Medicare surcharges based on your income. If you own property, you got to pay property tax. If you buy things at the store, everything's hit with sales tax. If you do investments, you may have long-term or short-term capital gains taxes. Buy a vehicle, another tax, and resell a vehicle or buy a second vehicle over and over again, you pay that tax again and again. Every time we fill up at the pump, there's a gasoline tax. Then there's excise taxes on certain products, privilege taxes. There's a franchise tax for some businesses in the state of Texas. And finally, there's the estate tax, which kind of faded into obscurity, but now Joe Biden's working on some plans to kind of drop the limits, and many of us will probably be paying estate tax in the future. And so this is just a summary of the range of taxes on all of the many things that when we earn money, when we invest money, when we buy things, when we possess things, we're hit with just an ongoing array of taxes. And today's webinar is talking about we're going to talk about ways that you can manage and hopefully pay less tax. So the key to this problem is understanding all the taxes you're paying, then starting to make some informed choices to reduce your tax obligation. Because every dollar we get to keep is a dollar we don't have to give to Uncle Sam. And if we get to keep it, we can invest it and start to grow it. So here's today's tax topics. We're going to talk about ways to pay less income tax. We're going to talk about the Medicare IRMA surcharges. Higher individuals pay more for their Medicare coverage once they turn 65. We're going to talk about strategies to pay less tax on retirement accounts, IRAs, 401ks. We'll talk a little bit about capital gains tax. We'll talk about property tax. Texas has the 6th highest property tax in the country. We'll talk about some strategies that older people can take advantage of. We'll touch on charitable opportunities, although we have a full devoted webinar coming up in 2 weeks on charitable giving and tax opportunities with it. And then finally, we're going to ask for your tax questions. So let's start with income tax. We have a graduated income tax system in our country. Depending on the amount of income you earn, you pay tax at different rates. So for a single or married couple, if you're single and your income is above $9,950 a month, $9,950 a month or a year, the first $9,950 is paid at a 10% rate. Above that, you go into a 12% bracket. And then if you go above $40,525 of reported taxable income, you pay at a 22% rate. So you can see our income tax system is graduated based on the amount of income we earn. Well, within our code, we also get deductions. And up until a few years ago, a lot of people itemized. They would claim mortgage interest and they'd claim medical expenses and different items to reduce their tax obligation, reduce their adjustable gross income. Well, with the Trump tax tables that were passed several years ago, they increased the standard deduction. And so today, many people just claim the standard deduction. For married couples, that's $25,100 in 2021. And if you or your spouse are older than 65, you can claim an additional $2,700. If both of you are over 65, you can take another $2,700 off. So when I talk to people about income tax, I want to talk to them about establishing or looking for what might be their optimal gross income. If you see the number at the bottom of the page, here's an example of an optimal gross income amount. Let's say we take the ceiling on the 12% tax bracket for a married couple. That's $81,050. And I add to that my standard deduction, and if both my spouse and I are over 65, I add on $2,700. And this tells me if my gross income for the year is $108,850 or less, everything I'm earning is being taxed in only the 10 or the 12% bracket. Those are very low rates. So the question is, am I above or below this threshold? And there's opportunities both ways, whether I'm above or below these optimal gross income levels. So that's the question we ask. Are you above or below? You got to be one place or the other. If I'm below the optimal gross income level, well, this may be an opportunity to start converting IRAs over to a Roth IRA. So all of our traditional IRAs, 401ks, 403b funds, those all contain pre-tax funds that are fully taxable when we start withdrawing funds. If I am able to convert my IRA dollars over to a Roth, the beauty of the Roth is not only is it tax-free, but whatever it earns going forward is tax-free. So let's say married and my adjustable gross, I'm 70 or 68, and my optimal gross income is below that 108 threshold. Let's say it's at 100. Well, I've got an $8,000 window there where if I convert a portion of my IRA over to Roth, I can use up that $8,000 and only pay it at a very low 12% tax bracket. So once again, if I'm below, we need to look into doing Roth or IRA to Roth conversions. What if I'm above that optimal gross limit? Well, then we sit down with folks and we go, well, what's causing you to be above the limit? And oftentimes they come in and they go, well, it's a 1099 from a brokerage account or from my CDs. And if that's the income that's putting me over that optimal gross income limit, we need to investigate ways maybe to get below it. And one option is to investigate products that grow tax deferred. So, an example, Tara and I use annuities in our practice to help people create income to build a foundation in retirement of safe, secure retirement. Well, annuities grow tax deferred. So let's say I take the money I have in my brokerage account that's creating an annual 1099 that's causing me to be in the 22% bracket. And I go, gee, I don't like giving the government over a fifth of my earnings every year. So I roll the funds over to something that grows tax deferred. And now what happens? I allow the funds to sit in that account. They compound and grow because I'm not having to withdraw taxable amounts every year. And I get to decide when I want to pay taxes. When I take my money out of those accounts, yes, I'll pay taxes, but I can choose which year to do it. I may have other income sources that are fluctuating. And so I can pick the years where my other income sources are down to withdraw funds from my tax deferred accounts and thereby keep in the lower tax brackets. So we're always searching for ways to help people save money on taxes. This is an opportunity. I mentioned that higher income people pay extra for their Medicare coverage. A couple of weeks ago, we did a presentation on making smart Medicare choices. Turn 65, and there's some very good Medicare options that allow me to plan for my medical needs in retirement and not drain my piggy bank. Nobody wants to go to the hospital and have a major walloping, six-figure bill when they get home. So let's talk about how IRMA affects these income adjusted monthly adjustments. Let's talk about how IRMA affects what I pay for Medicare. And if you go back to the chart we showed a couple of weeks ago, you know that there's original Medicare left side of the page, which is generally what Tara and I recommend for most people. You get parts A and B from the government. A is hospital, B is doctor and lab. A is free, but B has a monthly premium. And that monthly premium is based on my income. Most people then add on a Medicare supplement or a Medigap policy, covers what A and B don't cover. That feels pretty good. And then on top of that, we may add on a prescription drug plan to reduce the cost of medications. That's the left side of the page. There's a right side. It's called Medicare Advantage plans. If you're interested in understanding these two different options in more detail, go to our website where all of the webinars are recorded. You can go to srctexas.com and click under the tab resources. And you'll see all of our prior webinars are recorded there. We have one devoted just to paying less medical expenses. Well, what portion of this is affected by IRMA? The answer is two parts. What I pay for my Medicare Part B to the government and what I pay for prescription drug coverage. And here's a chart that shows in 2021, if individuals or couples are in that top bracket below 88,000 for an individual or below 176,000 for couples, their monthly premium is $148.50. But if I go above that, if I'm only $1 above that threshold of 176 for a couple, let's say I'm reporting $176,001 of adjusted gross income, guess what? Now I'm paying $207 each month, which is an additional $59 a month for both me and for my spouse. And that starts to hurt. As I go into the higher tax brackets, you can see what we pay goes up. What about Part D, the prescription drug coverage? Once again, if I make above those thresholds, I'm paying a surcharge, which is a nice way of saying I'm paying an additional tax. So Let's see if we can figure out a way not to pay that. And here's the summation. So if you put both B and D together, if I'm in the higher brackets, you can start to see how much more that people pay. Well, what's the problem with the higher IRMA surcharges? They're not based on the income I'm earning in 2021. What are they based on? IRMA is based on my modified adjusted gross income calculation from 2 years prior. So they're looking at what I made not today, but what I made in 2019, pre-pandemic. Well, a lot can change in 2 years. Maybe I got married. Maybe I got divorced. Maybe there was a death of a spouse. Maybe I retired, stopped working. Maybe I had a work reduction. I've cut back at hours at work, or I've had a loss of income from income producing properties. Maybe I lost a pension. Maybe there was an employer settlement 2 years ago, a payment, a lump sum that doesn't apply today. Well, in any of these life changing events, I need to inform Social Security that, hey, Bill's not a high breadwinner anymore or high hitter. Now I'm a lower hitter. And I can file that and report that with Form SSA 44. And by doing that, they will adjust my IRMA charges to what I should be paying, not based on what I earned back in 2019. Sometimes tax information gets corrected. You file your tax return, and then the CPA goes, wow, we missed something. We need to file a corrected return, maybe get an additional deduction. Well, you can file Form SSA 561 U2 with the Social Security Administration and tell them, hey, I know what I reported in 2019 appeared to be high, but it was actually lower. I'm now below one of those thresholds. Please adjust my IRMA surcharges. Once again, if you don't tell them, they're not going to reduce your IRMA and you'll pay more every month until your income finally does go down. Less tax on retirement accounts. We did a webinar strictly on how to maximize the value of your retirement accounts a number of weeks ago. You can go to our website and listen to that again. And today I just want to talk about tax strategies that are relevant to retirement accounts. Because what do we have primarily when we come into retirement? Most of us have a home. That's a high net worth item. And most of us have IRAs, 401ks, 403bs. We have retirement accounts that were created while we were working. Well, those retirement accounts, when we start drawing against them, it impacts what you and potentially what your heirs will pay if they inherit those accounts in the future, what they pay in taxes. And all of this changed with the passage of the Secure Act a couple of years ago. We used to have to start taking required distributions out of our IRA or 401k when we turned 70 and a half. Well, that changed, and now the new start age is age 72. So if I'm turning 72 this year, I have to start taking required minimum distributions. I'm showing here a 3.6% withdrawal as we turn 72. That's actually the number that'll go into effect next year. The IRS is redoing the table that says how much you have to take out, but let's say it's 3.6% annually. Every year we get older, that percentage is going to go up. So it starts low, but it starts moving north, and most of us won't make it to 115, but if we made it to 115, you have to take out 50% every year. Well, these increasing percentages could impact our future income tax bracket. They could force us up into a higher bracket. And also, the current tax rates that the previous administration put in place, they sunset at the end of 2025. And if Joe Biden doesn't do anything about it, we will revert back to the pre-tax rates that Trump implemented. We'll relate back to them. We'll go sunset and go back to those older, higher tax rates. Once again, if we're in a higher tax bracket, that may also cause us to pay the IRMA surcharges. So let's talk about a couple of ways to minimize or eliminate tax on our retirement accounts. Well, the first one we've already touched on. You and I can do gradual Roth conversions, and we can do that before and after age 72 and gradually transfer money from a taxable IRA over to a Roth IRA, which is tax free. There's also a way we can do smarter RMDs, and Tara and I do a lot of this with our clients. So let's talk about doing smarter required minimum distributions. So once again, we turn 72, we don't have a choice. You have to start taking money out of your IRA. Well, on the left side, I've got a traditional IRA, big chunk of money. On the right side, I divide that IRA into two components. I'm showing it 50-50 here, but there's no magic to that. It could be 60-40, 70-30. You divide it up however you want. And in the case of what we do on the right side, we're taking a portion of the IRA and positioning it still in an IRA, but we're putting it into a shielding vehicle called an annuity. We'll explain how this may provide some benefits. So what happens when we turn 72? Most people start dipping. This is traditionally what people have done. They go to the chart. Chart says, well, I'm 72 and I got to take out a certain percentage. So they make a withdrawal. And what happens on the right side? Well, we add a feature onto the annuity. It's called a lifetime income rider. And we turn that income rider on. Well, the amount coming out of the annuity satisfies the RMD requirement for that chunk of money. It may also satisfy some or all of the RMD requirement for the bucket of IRA funds to the right of it. Well, what's going to happen over time? The percentage is going up. So what's happening on the left side? As our annual dipping increases, generally the size of the IRA is contracting or shrinking. On the right side, that IRA annuity, we've got that lifetime income stream turned on. And Tara and I like to pick products where the lifetime income stream increases every year if the stock market is up. It can never go backwards, but it can get bigger. And often it does, often doubling or even getting bigger than that from what it originally starts at. So that increasing income stream, once again, is satisfying the RMD requirement on the right side. What's that allowing the bucket on the far right to do? Well, I'm not having to tap any RMDs, so it's increasing because the annuity is satisfying all the IRA requirement. But what's going to happen? Over time, this process will continue. My IRA on the left side is shrinking. Now, by now, the IRA annuity may have gone to zero. Oftentimes, when we run models, we find that we drain the IRA annuity around the mid 80s, 84, 85. That sounds bad, except remember that income stream is a lifetime payout. If you're married, we set it up joint life. So, ladies listening in, this part of the presentation is for you. If you outlive your spouse, and ladies tend to do that, this is a lifetime income stream that you'll receive. It'll continue to increase as long as either or both of you are alive. Nice way to plan ahead for inflation in the future because things are going to get more expensive. But this isn't all the good news. What happens when that IRA annuity is almost empty? Well, we go through one more step and we convert it from a traditional IRA to a Roth IRA. Now, since there was only a little bit of money left in the bucket before we did the conversion, how much of the go forward future lifetime income is taxable? The answer is none of it. It's now tax free income to you. So not only do you have an increasing stream of income, but it's an increasing tax free stream of income. That feels good. That's like giving yourself a raise in your mid 80s. We may all need that. Who knows? With inflation, our buying power gets diminished, and having more and more guaranteed income in retirement is a way to ensure a safe, secure retirement. So, this is one of the ways that Tara and I show our clients how to go from taxable qualified funds, taxable 401ks, 403bs, IRAs, how to move to a point where actually you're getting tax-free income in retirement. That feels pretty good. If you have questions about this, come and see us. We can do this as a tax-free exchange up front and make life a lot more fun in the future. Here's an example of the impact of doing this. We had clients come in last year, Lucy and Bill. They were both 68. We said, "What's your monthly budget in retirement?" And they said, "Well, we need $6,000 to live comfortably in retirement." We indexed that for 2.5% inflation. So we plugged that into our software because we know what Bill and Lucy spend this year won't be what they spend in 5 or 10 years. Things are getting more expensive. Try to build a house today, you'll find lumber has tripled in cost or maybe even gone up more. Well, then we looked at Bill and Lucy's Social Security income, and we decided to work on a strategy to maximize it. Lucy claimed at 68. Bill's going to wait till age 70 so that he can maximize his lifetime benefit. And if he passes away, which we think Lucy will probably outlive him, she'll step up to that much higher Social Security benefit. That'll feel good. Now, their savings, they had about $725,000 in liquid savings. Most of it, 675, was in Bill's 401k, and we project that's growing at a 5% annual rate. We looked at their life expectancy, and Bill and Lucy comes from a family that lives close to 100, not so much for Bill. Bill probably will live into his early 80s and then may pass away. So we want to make sure we provide protection for Lucy going forward. So this is scenario number one. This is doing nothing. Then we looked at a second scenario. We said, well, what if Bill and Lucy convert a portion of that 401k over to one of those annuities that's going to generate monthly income? And we ran some numbers, and by converting over a portion of their 675,000, we took 275. At age 70, that's going to generate a stream of income of 1107 a month, and that income will continue to grow if the stock market is up. That's going to feel good. So how does this income them impact them? Well, we ran numbers out to age 100 for Lucy. We know that their expenses are going to continue to rise. And on top, here's them retiring at age 70, claiming Social Security at those ages. And when Lucy turns 100, she still has $345,000 in the IRA. That's pretty good. But what if we do the annuity? Well, at about age 86, that income is flipping from taxable to tax-free. Then look at the bottom number. By age 100, we've increased Lucy's projected assets $241,000 just by converting a portion of the IRA over to something that generates lifetime income. So if your kids are listening in, ask them this question. Do you want to inherit $345,000, or would you like to inherit $587,000? Most of them are going to say, hey, I like that bigger number. So we talk about reducing taxes on retirement accounts. I want to go back to that Secure Act that was passed a couple of years ago. Why is this impactful? Well, it impacts our kids more than it affects us. The Secure Act eliminated something that's been the foundation blocks of IRA planning for 30, 40 years, and that is lifetime stretch. If you die owning an IRA, up until the Secure Act, your kids could inherit your IRA. Since they're much younger, they too had to take required minimum distributions, but the amount was very small because they're younger. And so they could literally spread their tax obligation over their entire lifetime. They could do a lifetime stretch. The amount not withdrawn continues to grow. So your IRA could actually become your kid's IRA and their retirement plan or a part of it. But what did the Secure Act do? It changed the rules and said now all IRA funds must be paid out within a 10-year window. Well, why is this a problem? If you die at age 80, your kids are probably in their mid-50s, maybe in their peak earning years. And now they're forced to withdraw all of their inherited IRA funds at the same time that they're paying higher taxes from regular employment. And this just put them into a higher tax bracket. Guess who's smiling? Uncle Sam. He now becomes one of your biggest heirs. So this tax thing is a complex area. With each of these strategies, Tara and I make a simple request. Come see us. Our consultations are always free, but let's sit down and crunch some numbers and see if we can figure out a way that you and your kids will pay less taxes. Every dollar you don't pay Uncle Sam, it's a dollar you get to keep. And the strategies we use for protecting money in IRAs, there's a variety of them. I'm not going to delve into these in detail. One is naming a charitable remainder trust as an IRA beneficiary. There's tax advantages to doing this. With some of our other clients, we do what I call wealth replacement. We take money from an IRA and we take out a portion of it over, say, a 10-year period. We use that, the after tax proceeds, to fund a life insurance policy. Why do we do that? Because everything that comes out of a life insurance policy while you're alive or after you die to your beneficiaries is tax free. So we're now, once again, converting taxable IRA dollars into something your kids will much more enjoy inheriting because they get a lump sum life insurance payment. No taxes are due at all. A third strategy that we use is sometimes naming beneficiaries other than a spouse. Sometimes, normally we name our spouse as the person who's going to get all the funds. But by dumping all the IRA money into one spouse's bucket, it's forcing them to pay more in required minimum distributions. And it means when they leave money, it's probably going to hammer the kids. So sometimes we look at what I call a split beneficiary strategy, where we leave some of the money to the spouse, but some of it we get over into the kid's name earlier. And if one of your children is in a low tax bracket, maybe they can accelerate doing IRA to Roth conversions at a very low tax rate. Another form of tax we pay is capital gains tax. And capital gains usually gives us a favorable tax treatment. How does it work? Well, some investments that you put money into when they earn, if you cash them out in the first year, you'd pay normal income tax on the earnings. But then we have what's called long-term capital gains. And depending on your other income, the tax bracket for long-term capital gains could be as low as 0, 15%, or at a maximum 20%. Now that's much lower than the high bandwidth taxes that income tax has to pay. So people look at ways of using capital gains strategies as a way of reducing their tax obligation. Now, Mr. Biden is working on revamping this. So, what I'm going to share with you is based on what occurs now, not what may be in place after a tax overhaul. The other thing you need to know about capital gains tax assets is that usually they come with a step up in basis at death. What does that mean? Well, let's say I buy a share of IBM stock for $100. And if I own that and it grows to $200 in value and I sell it during my lifetime, I'm either going to pay normal income tax if it's within 1 year, or I'm going to pay long term capital gains. But what if I die owning that share of IBM and I leave it to my son? Well, he gets a step up in basis. The stock has gone from 100 up to 200. He inherits it at 200, and guess what? He could sell it the next day and pay no tax at all. So when we're doing tax planning, we're also looking at ways to do estate planning, to pass assets tax-free or in minimal tax to the next generation. And a good example of this is our homesteads. If you're a single person and you own a home, or a married couple and own a home, and you sell that home after it's grown in value, single people get a $250,000 step up in basis during their lifetime, or a $500,000 base increase for a couple during their lifetime. So my wife and I own a home. If we're lucky enough to sell it, and in Austin the price of homes is going up, and let's say we have a $500,000 gain on our home, we're still both alive. Well, that first $500,000 of gain is exempted from taxes. The amount above that, since we've been in the house for many years, subject to long-term capital gains tax. A whole lot better than paying normal income tax. But this usually begs a question. People come to us and they go, "Hey, Bill, long-term care is looming on the horizon. I've heard those nursing homes are pretty expensive. Once again, go back. We did a webinar on how to not pay for long-term care several weeks ago. But I've got a home and I think I'm going to deed it over to my kids. Is that a good move? My answer is usually no. Why is that? Because if you die owning the house, there's ways to protect it from Medicaid estate recovery. People worry about that, but we have ways of protecting the home. We have ways of passing the home so it doesn't go through probate. And that saves your kids some money in the probate courts. But the biggest reason we avoid passing assets to the kids, if you were to you bought your house for 100,000 and it's worth 400,000 today, you have $300,000 worth of gain. If you pass your house to your kids while you're alive, they assume your original basis, what you originally paid. So if they turn around and sell it the next day, that $300,000 gain would be subject either to normal income tax if it's within 1 year or to long-term capital gains tax. Both are big ouches. We don't want to pay those kind of taxes. So the answer on a home, hold the asset till you die, shield it from probate, shield it from Medicaid estate recovery. And then when your kids inherit the home, they get the step up in basis. And if they sell it the next day, they don't owe any tax at all. That feels pretty good. So if you have questions about this, this is something we'd happy to sit with you. Consultations are always free. Another thing that we get hit with, I mentioned earlier, Texas has the sixth highest property tax rate in the country. Ouch. I don't know about you, but I always look for that appraisal district appraisal every year and go, wow, how much are they going to raise me up? If you live in the Austin area, you know that our home prices are skyrocketing, which means so are our property taxes. Well, here's some good news. When you turn age 65, we can request a tax ceiling or a tax freeze on our homestead. If you're married and one of you is turning 65 this year, head to the appraisal district in your county and request the tax freeze. Now, the tax freeze generally only applies in many counties to the school portion of the property tax, but that's the lion's share of your property taxes. County taxes, mud districts or utility district taxes don't get frozen, but those are usually a very small portion of your property tax. Once you freeze it, even if your home increases in value, there's a ceiling or a tax freeze on the school portion, and that feels pretty good. You're not seeing these increases that are paralleling the price and appraisal increases. What if I move after age 65? I can request a tax ceiling transfer. Let's say I'm moving from Burnett County, where I live today, to Williamson County. Well, I go to the Burnett County Tax Appraisal District. They issue a letter saying this portion of Bill's property is frozen, and I can get that same level of deferment or tax freeze when I move to another county. What if I die and my widower is less than 65? They too can maintain the tax ceiling continuation. So the taxes are frozen, even though they're younger than 65. Another option that's available to people over 65 is what's called property tax deferment. Let's say I'm kind of operating on limited means and I turn 65 and I go, let's see, I can afford food or property taxes, but not both. Well, I can go to my tax authority and request a property tax deferment. And that doesn't mean I don't have to pay the tax. I just don't pay it now. The property tax is still due. It grows in interest over time. But because I'm not paying it, I have money to live on and to pay my other bills, medical or food or utilities. So this is an option that we talk to some of our folks about. Some other options that you want to investigate, each county is unique in Texas, but some of them offer solar discounts or tax credits if you put solar panels on your home. Well, that's kind of a double win. You're going to save on energy costs in the future. You'll probably increase the value of your property because a home with solar panels is viewed as being more independent, and you get a tax credit on your property tax. I like that. Veterans often are eligible for a variety of tax credits. So once again, if you're a veteran, particularly if you have a disability, contact the appraisal district and ask, hey, how does my disability affect what I would pay in property taxes? Many veterans that have 100% disability pay no property tax. That sounds pretty good. So this is one where you got some homework. Contact your appraisal district, find out what credits, what different options exist in your county, and see if you can take advantage of them. Charitable opportunities. I'm going to touch on this quickly because this part of the presentation is focused on our higher net worth individuals. And in 2 weeks, we have a webinar focused solely on this, on how to take advantage of charitable opportunities to both increase what you and your spouse have, but also to help support your favorite charity. And so for folks that have accumulated nice estates, they may have a philanthropic mission. They may have certain tax exempt charities, churches, schools, different organizations that help throughout our community, and they want to participate in supporting those charitable missions. Well, why not also benefit by getting some tax breaks? And so one option is we can donate highly appreciated assets that normally, if I were to sell those assets and donate money to the charity, what would I have to do first? I'd have to pay long-term capital gains tax. But if I donate those highly appreciated assets, I can donate the full amount, and the the tax-free charity doesn't have to report taxes on it. So all my money goes to helping my favorite philanthropic mission. We can also create sizable tax credits. One of the strategies we work on helps individuals that donate property create a 60% tax credit. 60% of the value of what's donated is a tax credit. What might we use that for? Well, remember we got those IRAs that are going to be taxable in the future? What if we apply that tax credit to the IRA or 401k and convert it essentially tax free into a Roth? Wow, that feels pretty good. Now, whatever my Roth earns, I don't have to pay tax on, and my kids will never pay tax on what it earns when they inherit it. The other thing that we look for when you set up one of these charitable contributions, we look for opportunities where you can receive tax advantaged lifetime income from the charity. And so there are strategies where you can create a income stream that has other tax advantages. It's not taxed at the same rate as normal income tax. So if any of this seems to maybe be in your wheelhouse, give us a call. We have experts that help us put together very interesting tax plans for our clients where they can save tens of thousands of dollars now and also pass tax-free assets to your kids in the future. These are the kinds of opportunities that can benefit you both now and make your kids smile in the future. Boy, we've covered a lot of ground in the last 44 minutes. So I want to thank everybody for joining us. And now I'd like to turn it over and allow you to ask questions. Tara, do you want to tell the folks how to ask questions?
Sure. If you go to the top of the page, there should be a talk bubble in blue, and you can click on that, and then you can type in your question, and we'll be able to see your question. So first question is, this was pertaining to back on one of your slides, but if the IRA annuity drains to zero, does IRS not consider the value of the lifetime income after conversion and thus tax that?
Well, that's a great question. And this is one of the very creative legal tax strategies that Tara and I have worked with our clients on for a number of years. When you convert an IRA to a Roth, you pay tax on whatever the current account value is. So let's say I have 100,000 in my IRA. I want to convert it to a Roth. I'd have to report 100,000 in taxable income. That plus my other income maybe puts me in one of those higher tax brackets that doesn't feel good. But with the annuity, I fund the annuity with 100,000. and we start drawing down against it. When it's down to 5,000, I go back to the insurance company that helped set it up and I go, hey, I want to convert my IRA to a Roth. What's the account value now? 5,000. That's what I pay the tax on. It's not based on the income. It's based on the taxable account value. So I pay tax on 5,000, which is minimal. And now the go forward income stream is tax free. Now, there's one other caveat on this we didn't cover because I've tried to keep my webinars simple. But when you take money out of a Roth, the Roth has to exist for at least 5 years to take it out tax free. So, with all of our clients, we not only do we set up the annuity, but we also help them convert and set up a small Roth today. The purpose of that Roth is not to grow into a sizable asset. I mean, it's wonderful if it does, but it's to allow the account to exist for 5 years. So in the future, when we make the conversion on the annuity to a tax-free income stream, we divert that income through the Roth that has existed for 5 years, and it's a legal transfer. So anyway, this is complex. There's no quiz. We're not going to make you memorize this, but we can show you strategies to do this.
Okay. Next question. If I have IRA money I want to convert to a Roth, how much do I know? How do I know how much to convert?
Great question. And this is where the power of the software that Tara and I use comes into play. We have software, it's called Retirement Analyzer. And it is very complicated, but it's also very simple. We build in your budget in retirement by individual cost element, like housing, utilities, food, medical expenses, insurance programs. We build all that in, and each one of those may have a different inflation factor. We then build in your assets, and we put in a growth factor for each one of the assets. We then build in your income. We know that you're going to get Social Security in most cases. We try to maximize that. We then build in pension income or other sources of income that you may be receiving. Now we have a baseline scenario. And we go forward 20, 30 years and we see where you're going to be. Then we start looking at what if I gradually begin to convert IRA over to Roth? And since I know when I cross one of these tax thresholds, I pay a higher rate, we try to stay below those tax rates, but yet gradually get all of the IRA money converted over. So it's not something I can show you over the internet, but if you come to our office and we build a model, I can show you how to gradually convert your IRA money tax efficiently into Roth funds where you won't pay any future tax.
And this other question we have may be same answer, but should I convert all my money to Roth now or over a number of years?
Well, once again, it depends on what your other income is. If converting it all now would push you into the 32% tax bracket, probably not a good idea because you're giving a third of your money or almost a third to Uncle Sam. The other thing I'll say about Roth conversions, if you can pay the tax obligation on the conversion amount from other after tax funds and convert the full IRA amount over to the full Roth amount, there's a tax advantage to doing this. And once again, our model shows the effectiveness of this. If you're going to take 100,000 out and pay the government 22% of it, and then you have only 78% left, if tax rates go up, it's still effective. It's still better to be in a Roth, but the advantage is not as great. But if instead I can pay that 22% tax bill out of other non-taxable accounts, like a brokerage account or a bank account where I've got money, after-tax money, then there is an advantage, a much bigger advantage to getting into Roth. So generally we do it gradually, not in one fell swoop. And when we do it, if we do roll money over to an annuity, that's a tax-free exchange.
All right. Well, I think that's our last question. So thank you very much for joining us today. And again, please, contact us. Our email addresses are first name, Bill, or then Tara at srctexas.com, or give us a call. We had one last question come in before we go. Let's grab that one. Oh, just a thank you. You are welcome.
And also, Tara, don't forget to tell them next week we're going to be focusing on another legal topic. We're bringing back Andy Friedman, local elder law attorney, one of the best elder law attorneys in the state of Texas. He's already helped us with 2 prior presentations. And next week, he's going to devote his talk to the role that trusts play in retirement planning. And like anything else, trusts can do a lot of different things. So he's going to keep it simple, but he'll give you a high level overview of where trusts may be a fit, may help in your retirement planning. And I think the week after that, we're going to go on and talk about philanthropic giving. We have a special guest speaker who's going to come in and help us with that topic. And then our final topic in the 13-week series is going to be on strategies that younger people can do in planning ahead for retirement, where they minimize their future tax obligations. So if you've got a son or daughter who's in their 40s or 50s, have them join us for that one, because there's some very interesting opportunities that they can take advantage of. So, Tara, say goodbye, and I'll say goodbye, and ever have a great week. And if you have questions, give us a call and come and see us, and look forward to helping you.
Have a great week. Bye, everybody.